Supermicro SMCI, shares closed recently around $29.71, down roughly 1.3% on the day. This pullback is noteworthy because SMCI is trading near its 52-week low, about 27.60, despite having just delivered a blowout quarter. Coming on the heels of record-breaking revenue, today's weakness signals a critical inflection point. Is the market finally doubting SMCI's execution or simply digesting a whipsaw in sentiment? After spiking on Feb 3rd to nasporish $30.30 in after-hours trading following a massive 123% YoY revenue beat, the stock now hovers back near $29 to $30. That suggests profit-taking or caution has overcome the post-earnings euphoria. The move matters because at this price level, SMCI sits on the brink of key technical support, and a breakdown here could confirm a longer-term downtrend. Conversely, a resilient base at 28 to 30 could mark an eventual floor for investors. Either way, today's action will be analyzed closely as a possible turning point for this high-flying but volatile AI hardware play. Technically, SMCI's chart shows significant pressure. The stock recently broke below its 50-day moving average, around $30.97, and trades far below its 200-day average, about $39.73, underscoring a steep downtrend. Short-term support levels loom near 29.2 and 28.8, with resistance around 30.3 and 31.4 as identified by bar chart's pivot points. Notably, SMCI's 52-week range spans $27.60 to $66.44, so today's low $30 price is closer to the bottom of that range. Market sentiment indicators are bearish. Bar chart's technical opinion scores SMCI as a strong sell, 72% sell signal. Moreover, trading volume has thinned out. Roughly 16.7 million shares changed hands midday, about half of its 34.5 made average, suggesting low conviction and less retail buying interest. The stock's beta, actual 1933, also implies above-average volatility, meaning any catalyst can swing sentiment sharply. From a psychological standpoint, the price action reflects investor doubt. A rally above $31 on heavy volume would hint at renewed confidence, but further declines below $29 could trigger stop-loss selling and amplify a bearish cascade. In sum, SMCI now teeters near support, and which way it breaks could set the tone for the next trend. SMCI is a technology hardware company specializing in high-performance server and storage solutions. In industry classification, it sits in the computer hardware sector. Supermicro's core business is designing, manufacturing, and selling energy-efficient, application-optimized rack mount and blade server systems based on the x86 architecture. Its product mix spans conventional data center servers, GPU and AI servers, as well as networking and storage components. The company's value proposition has long been rapid innovation and modular building block architectures, allowing customers to configure end-to-end data center solutions. In recent years, Supermicro has repositioned itself as an AI infrastructure specialist. Over 90% of its revenue now comes from AI-focused deployments. CEO Charles Liang emphasizes Supermicro's evolution into a leading AI platform and data center infrastructure total solution provider. In practice, this means the company not only sells server hardware, but increasingly offers integrated solutions, like its Data Center Building Block Solution, or dcbbs, aimed at cloud hyperscalers, enterprises, and emerging AI workloads. While SMCI is far smaller than industry giants, Dell and HP each hold much larger market share, it competes by serving niche requirements, e.g., super high-density GPU racks, custom configurations, and by tailoring to rapid AI HPC product cycles. Overall, Supermicro's business model is that of a hardware-as-solution provider. It earns revenue from selling server systems and related services, with a strategy of high-volume sales of relatively thin-margin units in exchange for massive throughput. The company's long-term vision is to capture AI-driven data center growth globally, leveraging its modular designs, U.S. manufacturing, and partnerships, e.g. with NVIDIA, to stay ahead of customer needs. Institutional positioning in SMCI is mixed and telling. Analysts collectively rate SMCI as a hold with a consensus price target in the low 40s, about 43.4. Notably, major banks are divided. Citigroup recently cut its target to $39, neutral, and Bernstein lowered theirs to $37, market perform, while bullish firms like KGI Securities and Rosenblatt maintain $55-$60 targets. This dispersion indicates uncertainty among professional analysts. On the hedge fund front, data suggest both accumulation and distribution. In Q3 2025, 111 institutional investors increased SMCI stakes, while 123 decreased them, reflecting a split view. For example, Mizuho Markets added 703,690 shares, 33.7 made in Q3, signaling confidence in a rebound, whereas trading firms like Belvedere, IMC Chicago, and Thames Capital significantly cut or liquidated positions. These moves underline that smart money is not uniformly bullish. Some large funds are rotating in, but others are exiting. On the insider level, the story is also cautious. According to SEC filings, Supermicro's executives have been net sellers. For instance, CEO Charles Liang sold 700,000 shares, roughly $34.5 million worth, in the past 6 months, and other top officers similarly offloaded stock. Such heavy insider selling usually reflects profit-taking or lack of confidence in near-term upside. In aggregate, these patterns suggest institutional and hedge fund interests in SMCI are uncertain to bearish. Trading volumes have tapered off, about 52% below average on dips, and many institutions seem content to wait on the sidelines until margin stability and customer diversification are proven. Financially, Supermicro's growth is undeniably impressive, but comes with stresses. In the latest quarter, Q2 FY 2026, revenue surged 123% year-over-year to $12.7 billion, driven by insatiable AI infrastructure demand. However, margins are under pressure. Non-GAAP gross margin plummeted to about 6.4% from actually 9.5% in Q1 due to product mix and higher logistics costs. Thanks to massive operating leverage, operating expenses remain tiny, at 1.9% of sales, but even small margin moves severely impact profit. Ultimately, Q2 non-GAAP EPS was 0.69, beating forecasts, versus only 0.22 last year. At roughly 674 million diluted shares, GAAP basis, that implies net income in the high hundreds of millions. The balance sheet appears solid on its face. SMCI ended Q2 with 4.1 Bs in cash against 4.9 Bs of total debt, net debt 0.79 B. Quick and current ratios are above 1.0, reflecting adequate liquidity for now. However, working capital is stretched. Inventories surged from 5.7 B to 10.6 B in one quarter as the company stockpiles components for future demand, and account receivables jumped, which led to almost break-even cash flow. 24 mailers used in Q2 versus 918ers used in Q1. The cash conversion cycle improved to 54 days, but that largely hides how much capital is tied up. Free cash flow remains slightly negative, 45ers in Q2 after 21 mailers capex, meaning the cash burn hasn't flipped positive yet. In summary, SMCI is profitable on paper and growing fast, but it's working capital intensive and currently running with negative free cash flow. Its debt load is moderate, but rising, and the share count has grown to 668 million non-GAAP, modest dilution from stock-based comp. Overall, the financial fundamentals show a company betting aggressively on growth. Revenue and profits are booming, but margins, cash flow, and concentration risks make it less stable than the top line suggests.